Ever since Daniel Goleman's book Emotional Intelligence was released in 2005, people have been talking about the term as a previously overlooked approach to human perception, often shortened to EI and sometimes called emotional quotient or EQ. It argues that some people are just better at reading the room and being empathic. We all know people who are generally more inclined towards situational awareness. That's EQ. Some observers have gone so far as to suggest that EQ is more important than IQ as a determinant of life success. The book's promotional notes go so far as to suggest that the concept may redefine what it means to be smart. Everyone knows that in finance, the ability to control emotions is essential. What is now coming to the fore is that the ability to understand, interpret, and respond to your emotions and those of others is a critical component of investing success. The burgeoning field of behavioral economics is where the rubber hits the road. Depending on how you keep score, there are at least 3 Nobel laureates, Daniel Kahneman, Robert Shiller, and Richard Thaler, who owe much of their reputations to their work in helping people understand the impacts and consequences of how we behave. Their research and insights are also forms of emotional intelligence. It's often been suggested that good investing is simple but not easy. What that means is that the concept is intellectually simple. All you really have to do is buy a broadly diversified, low-cost basket of securities that meets your risk tolerance and capacity and hold it for a long time horizon, remembering to rebalance from time to time as markets move and new money becomes available. The problem, despite the intellectual simplicity, is the emotional challenge that accompanies it. It's not easy. As you apply the EQ concepts to retirement planning and investment returns, examples abound where your focus and discipline will be challenged even if you know perfectly well what the industry would prescribe. The most obvious examples revolve around how individuals might react if there's a severe and/or prolonged market downturn. In that scenario, considerations include an awareness of personal limitations and tendencies, the degree of self-confidence and self-assurance you have, the ability to let go of mistakes, the ability to accept and embrace change. It should be obvious that your ability to manage emotions in difficult situations is paramount. One thing that I've been personally concerned about is something I call bullshift. The financial services industry's tendency to shift your attention to make you feel bullish. Bullshift can magnify the harm done by a lapse of emotional intelligence if you're not careful. I fear that the industry has failed to do enough to prepare ordinary investors for a prolonged and protracted bear market. Sure, the industry tells people to take a long-term view, but how many people are really aware that, for instance, the Nikkei 225 index in Tokyo finally hit a new all-time high in 2024, and that the previous high was set in, are you ready for this? 1989. Just how long is wrong-term anyway? I feel that people are unduly prone to optimism bias, the viewpoint that, well, bad things might happen all the time, but people might become complacent, and they act, therefore, as though those bad things won't happen to them personally. It would likely serve people well to take an inventory of how long they could honestly hold out if markets were to drop by, say, 50%, thereby causing a balanced portfolio to drop by, say, 30%. My view is that many Canadians who insist they have the emotional intelligence and steely resolve that goes with the long-term mindset might lose their nerve and succumb to making a rash decision if they encountered such a turn of events. In some instances, that's because they don't have the emotional constitution to hold out. In others, it's because they simply miscalibrated how much they would need and for how long before things normalized. This is especially critical for retirees because they no longer have the ability to add to their savings or buy the dip the way they might be able to when they were younger and still in the workforce. The Greeks had a saying, "Know thyself." While centuries old, the advice remains valuable to this day. That kind of self-awareness is often more emotional than it is intellectual.